Hello and welcome to the 248 Emerging Companies Fund's quarterly report for March 2025. We've been providing these quarterly updates for over 5 years now, and it always feels like something dramatic happens in the March quarter. In March 2020, it was COVID. In 2021, the renewed lockdowns. In 2022, war in Europe, the tech roll-off and a crypto meltdown. In 2023, the collapse of Silicon Valley Bank and the explosion of ChatGPT as both an opportunity and a risk. We got some relief in 2024, but in 2025, the drama is back. We hadn't moved out of January before the release of DeepSeek, a newer and importantly much cheaper Chinese version of ChatGPT, blindsided investors and precipitated a sell-off of large global tech names and forced a rethink about investing in AI. While the market falls persisted through February and March, and at the time of writing, we're dealing with the chaos erupting on world financial markets as a result of US tariffs, which has left many companies reorganizing their supply chains and investors questioning the likelihood of a global recession. So what does this mean for our portfolio companies? The tariffs impact companies importing product into the US. Across both funds, only 4 of the 17 portfolio companies produce products, with the remainder selling services or software, which are not subject to tariffs. Of those companies, only 3 sell in the US and are trade exposed. That's CleanSpace, BirdDog, and Bellroy. BirdDog is too small a position for any outcome to be material to the fund. Bellroy and CleanSpace are material. In the case of CleanSpace, although the US has historically been a large market for them, at present it's minimal. They also have very high gross margins, so any tariff levy is likely to have a much smaller impact. We estimate the immediate impact on CleanSpace to be immaterial. Bellroy has a higher portion of sales into the US, but again, it has very high gross margins, so the immediate impact again should be minimal.
One of the key achievements during the quarter was the completion of the sale of Mason Stevens in Fund 2. Fund 2 first invested in Mason Stevens in October 2022, and we were attracted to its strong market position, history of profitability, and alignment with management on liquidity. In October 23, Mason Stevens was poised to complete an IPO before market conditions intervened and the process was pulled. However, in December 2024, they entered into an agreement to sell 100% of their shares to private equity investor Adamantum Capital under a binding scheme implementation deed, which was subject to shareholder approval and court acceptance. The sale has now been completed and the proceeds were distributed to the fund unit holders in early April this year. As a reminder, the initial investment amount was approximately 10 million, with a total cash realisation of 14.9 million, or an investment profit of approximately 4.9 million. The return of 49% and internal rate of return of approximately 18% demonstrated Mason Stevens performed well over the holding period. Whilst unable to achieve an IPO as planned, the business continued to pay dividends and grow. Based on what we just talked about, a distribution of almost 30 cents per unit, or 16.6% of capital invested, was paid to Fund 2 unit holders in April, bringing the total amount of distributions in Fund 2 to almost 35 cents per unit out of initial $1.80, or 19.4% of capital invested. During the quarter, Fund 1 also realised a small remaining position in Swoop Limited. Realisations from the sale of Swoop totalled approximately $550,000, and the fund recognised a loss on the position.
Now let's take a look at the performance. For Fund 1 to the end of March. So the original committed capital for Fund 1 was $1.80 a unit, and distributions to date have been $1.31. Net asset value at the end of March was $1.31. So if you add distributions and the net asset value, you get a total of $2.63. The 3-month performance was about up 1%. Since inception, that's 45.9%, and since inception on an annualized basis, so IRR, it's 11.98%. There are 8 remaining positions left in Fund 1. Each company is actively in a process or engaged in discussions regarding a sale or a liquidity process. Now let's look at Fund 2. So the original committed capital gain was $1.80, and distributions to date have been 5 cents. So the net asset value at the end of March was $1.76, and so if you add distributions and net asset value, you get to $1.81. The 3-month performance, the since inception performance, and the since inception IRR are all about flat. Thanks very much for watching the video. If you're a unit holder and you want more information about anything discussed here, please either send us an email or give us a call. Thanks again for your support.
Thank you.